All right, let's get right into it. Today, we're putting a really fascinating and frankly chaotic stock on the examination table. We're going to use Pop Culture Group, that's ticker CPOP, as our case study. We'll give it a full technical checkup and see exactly how analysts try to find some kind of signal in all that noise. I mean, that's the big question, right? When you look at a stock chart and it looks more like a heart attack than a healthy investment, how on earth do you even begin to guess what it's going to do next? Well, that's exactly what technical analysis is for. It's the toolkit for trying to interpret that chaos. So, first things first, let's meet our patient. CPOP is, well, let's call it wildly unpredictable. For this analysis, think of us as the doctors. CPOP is on the table, and we're about to run a whole series of diagnostic tests to figure out its condition and maybe, just maybe, predict its future health. Now, just look at the sheer drama on this timeline. This all happened in just 3 months. We go from about 50 cents all the way up to an explosive peak of $2.61, only to completely collapse back down to $1 the very next day. You see, this isn't a trend, it's a roller coaster, and that is a huge red flag for an unstable patient. Okay, so every good diagnosis starts with checking the vitals, right? Before we get into any of the fancy tests, we've got to look at the most basic symptoms, the stock's price and its trading volume. You'd be surprised how much these two simple numbers can tell us about just how sick or healthy this patient really is. Let's start with the moment the fever spiked. On September 25th, the stock hit that incredible high of 261. This number really represents the peak of speculative heat, you know? It's that moment where pure excitement completely takes over logic. But as we all know, fevers eventually break. And boy, did it break fast. The very next day, the price just cratered all the way down to $1.01. To see it collapse that big in just 24 hours? Wow. That tells you that the peak we just saw was built on a foundation of sand. It was incredibly fragile. But here's what's really telling. Look at the trading volume. On a pretty normal day, you see about 22 million shares change hands. But on that peak day in September, almost 60 million. That's not just interest, that's a frenzy. A spike like that almost always points to short-term speculation, not long-term steady investment. All right, so we've observed the symptoms, the feverish price and the frantic volume. Now it's time to run some more advanced diagnostic tests. Analysts use these special indicators to look under the hood and get a much clearer picture of what's really going on with the patient's health. First tool out of the bag, moving averages. Now, this is one of the most fundamental tools that analysts use, but the idea behind it is actually pretty simple to get your head around. So let's stick with our medical analogy, okay? If the daily price is like a patient's heart rate jumping all over the place second by second, the moving average is like their average heart rate over a few minutes. It smooths out all that chaotic noise so we can see the real underlying trend of their health. And when we run this checkup on CPOP, well, the results aren't looking so good. The short-term average is heading down, that's bearish. The medium-term average is sitting around $1.20, and it's acting like a ceiling the price can't break through. And the long-term trend, basically flat. But here's the kicker. The current price is below all of these key averages. That is a really strong bearish signal. Okay, on to the next test. We've checked the average heart rate, but what about the patient's actual strength, their momentum? For that, analysts turn to an indicator with a fancy name, the MACD. MACD stands for Moving Average Convergence Divergence, but don't worry about the name. All you need to know is that it's basically a strength and momentum test. Think of it like putting the patient on a treadmill. A positive reading is good. It shows strength. But if that reading starts to drop, it's a huge sign that the patient is getting exhausted. And the diagnosis from CPOP's MACD test is crystal clear. This patient's momentum is fading fast. Now, technically, the indicator is still positive, but it's falling, and it's crossed a key line that suggests the energy behind that recent price surge is just draining away. The rally is running out of gas. Looking at our other vital signs gives us a mixed but still pretty worrying picture. The RSI is kind of neutral. Another indicator, the Williams %R, is screaming deeply oversold, which might suggest a little bounce is possible. But, and this is a big but, the ADX, which measures how strong a trend is at 67. That's a very high number, and it tells us the current downward trend is incredibly powerful. So even if we get a tiny bounce, the main force is still pushing it down. Okay, we have reviewed the symptoms, we've run the diagnostics. Now comes the hardest part of being a doctor, the prognosis. Based on everything we've seen, what are the likely paths forward for our patient? This is where analysts outline a few key scenarios. So you've basically got three potential paths here. The bullish or best case scenario is a little short-term recovery, maybe back up toward $1.30. The neutral case is just stabilization. The stock just kind of bounces around sideways for a while. But the bearish scenario, the relapse, is the real danger. If the price breaks below that key support level of 95 cents, that could trigger another really sharp fall. So after all the tests, all the analysis, what's the final word? What are the doctor's orders for anyone out there thinking about getting involved with this, let's call it a high-maintenance patient? Let's pull everything together. Honestly, this quote from the technical analysis report really just says it all, doesn't it? The final diagnosis is that CPOP is in a high-risk, volatile state with no clear trend. It's not healthy, it's not sick in a predictable way, it's just chaotic. And that is probably the most important thing to take away from all this data. So, here are the official doctor's orders. If you're a short-term trader, you have to prioritize risk management. This thing can swing like crazy. If you're a long-term investor, the advice is pretty simple. Stay away, at least until you see some real signs of sustained health, like the price holding above $1.40. And for absolutely everyone, remember, this is what speculative behavior looks like, not stable investing. Always, always check the fundamentals. Which kind of leaves us with one last big question to chew on. CPOP is just one of thousands of these high-risk patients in the market. So as you look at these kinds of opportunities, where do you personally draw the line between a bold investment and just plain dangerous speculation? It's definitely something worth thinking about. Thanks for tuning in.